We're boxed in. Are you exhausted? Are you worked out? We're at 90% now. Is this the final verbal nail in a March rate hike from Yellen? Do you think that's what we'll get?
Probably not quite, to be honest with you. I think that the message has obviously been one which is explaining why the market's moved in this direction to a large degree. But the Fed, the chair, we would think, will just want to be slightly cautious. You know, this isn't a done deal yet. We actually don't think ultimately that they'll go in March, albeit things are clearly moving in that direction. There's a lot of good in the US data recently, but there are some reasons to be careful as well.
Why do you think the market adjusted so quickly in the way it did to the commentary?
Yeah.
Because we've heard hawkish commentary from the Fed for some time, and yet something about the things that were said this week and the people who said them, maybe it's the fact that there were some dove voices in there as well, something about that just really captured the market, and hence we're at 90% probability.
Yeah, I mean, you're right to say, I think that some of those who have had more of a dovish reputation have sounded as if they're getting ready to vote for a hike in rates. That's obviously important. It's all about fine margins. You know, the US economy has been doing quite well for quite some time. The Fed are obviously keen to get rates higher, but they're keen to do so in what we describe as a sort of optimal way, and that doesn't mean to just get them higher as soon as you feel you can. It means ultimately to act in a way that allows you to get them well away from the lower bound.
But they're going to take that opportunity. Look, the one thing that struck me was, we read your notes. This is consumer confidence, and it's at a 10-year high. It's almost taken off since its inauguration in the back part of 2016. But that versus some of the consumption numbers, you have a different complexion when you look at the consumption numbers. You're slightly more irked by those.
Well, it's only early data for the first month of the first quarter of the year, and it can be slightly revision prone. But yeah,
I'll take French data anywhere.
Well, there you are. Real consumption, it looks like, was pretty significantly weak in January, and that can mean, apart from anything else, that the first quarter GDP number might be soft. We think it's tracking around 1.5% annualised, which is okay, but not stellar. Yes, consumer confidence has shot up. Obviously, there have been moves in other financial markets since the president was elected. But as the Fed points out, at this point, we don't have a lot of clarity about what the fiscal plans might be. We've just got the sort of overall framework. And as those plans are put into action, it may be that there's some disappointment ahead, which, among other things, brings consumer confidence down a little bit and just tempers the optimism we see around. Whether that's enough to derail or indeed to trigger a March hike, we'll have to wait and see.
And in conjunction with that, where do we see rates going then in the United States? We're pretty stable actually overnight, aren't we, on US 10-year, 2.478%. Are you in a 3% by the end of the year camp?
No, we're not actually. We think the yields are going to end the year not far from where they are now, frankly. We think that growth is going to be all right. We think the Fed ultimately will raise rates a couple of times this year. We'd question whether the sort of nearly 3 hikes that are implied by the dots are ultimately going to materialise. So we're pretty neutral on those longer-term US yields at this point.